Hi, Professor. In this presentation, I'm going to discuss impact of interest rate risk on bond valuation. So let's go over some fundamental concepts about bonds. A bond is a fixed income security that represents a loan made by an investor to a borrower, typically a corporation or government. It is a contractual agreement in which the issuer agrees to pay periodic coupon payments and return the principal at maturity. Bonds are used as a means of raising capital, and their prices varies based on interest rate, credit risk, and time to maturity. Some advantage of bonds are receiving income through the interest payment, hold to the bond to maturity and get the whole principal back, and making profit if have the opportunity to sell with a higher price. And disadvantages could be bonds pay out lower returns than stocks, companies can default on bonds, and bonds yields can fall. In bonds valuation, there are several keys. There are several key concepts that impact the pricing of bonds. One of them is interest rate. One of the primary factor affecting bond prices is interest rate risk, which refers to the inverse relationship between bond prices and market interest rates. When interest rate rise, bond prices fall, and when interest rates decline, bond prices increase. Another crucial concept is duration, which measure a bond's price sensitivity to changes in interest rates. Long-term maturity bonds generally have higher duration, meaning they experience greater price changes compared to short-term bonds. This increased sensitivity is why long-term bonds carry higher interest rate risk than short-term bonds. Another factor is yield to maturity. This factor represents the total return and investor expects total return and investor expect if the bond is held until it matures. Bonds with longer maturities often have higher yield to maturities due to the added risk exposure, a phenomenon known as the term structure of interest rate or the yield curve. Now let's go to our case study. So we have two bonds, A and B, with the same credit rating, the same par value, and same coupon rate. Bond A has 30 years to maturity, and bond B has 5 years to maturity. Now the question is, which bond will trade at a higher price in the market and why? Bond A will trade at a lower price than bond B due to the interest rate risk. Bonds with a longer maturity, as we just discussed, are more sensitive to changes in interest rates because their cash flow extend further into future, making their present value more affected by discount rate changes. This means that if interest rate increase, the price of bond A will drop more significantly than bond B. Thus, bond A would need to offer a higher yield to maturity to compensate the investor for this added risk, leading to a lower market price compared to bond B. In contrast, bond A, 5 years to maturity, is less affected by interest rate changes because its cash flows are closer to the present. Therefore, it will trade at a higher price than bond A. If we just want to look into the formula, we see the present value of bond price where C is coupon payments and R is interest rate and F is par value or face value. If we put the numbers in the formula, we easily can see the coupon present value for bond A with 30 years maturity is lower than bond B. Also, the par value contributes less in the bond's price as the maturity increase. Thus, the bond with the longer maturity has a lower price than the short-term bond, assuming that both have the same interest rate and the same face value. Second question is, what happens to the market price of each bond if the interest rate in the economy go up? When interest rate in economic increase, the market price of bond decreases. This occurs because bond prices and interest rates share an inverse relationship. As we see in the formula, that the bond price and the interest rate have the inverse relationship. Higher interest rate make newly issued bond more attractive as they offer higher yields, reducing demand for existing bonds with the lower coupon rates. As a result, investors require a discount on older bonds, causing their prices to decline. Additionally, longer maturity bonds are more sensitive to interest rate changes than shorter maturity bonds due to the extended duration of their cash flows, leading to greater price declines. Another question is, which bond would have a higher percentage price change if interest rates go up? The bond with a longer maturity, which is bond A in this case, will experience a higher percentage price change if interest rate increase. This is because long-term bonds are more sensitive to interest rate changes due to their extended duration, meaning their present value is more significantly impacted by changes in the discount rate, because as we know, there is an inverse exponential relationship between bond price and interest rate, as we show in the formula in the previous slide. When interest rate rise, the present value of future cash flows declines more for bonds with a longer maturity compared to the short-term bonds. As a result, bond A will have a greater percentage price decrease than bond B. In the as we see in the chart, as the interest rate increase, the bond prices decrease because they have, like I said, exponential inverse relationship. The last question is that as a bond investor, if you expect a slowdown in economy over the next 12 months, what would you what would be your investment strategy? So during an expected economical slowdown, a bond investor should adopt a defensive investment strategy focused on high quality, long duration bonds. In such conditions, central bank often shift from tightening to easing monetary policy to stimulate economic growth, which leads to declining interest rates. Since bond prices and interest rate have an inverse relationship, this drop in rate increases the value of the existing bond, particularly those with the longer maturity, as their cash flows are discounted at the lower rate. So additionally, investors should consider investment-grade government and corporate bonds that offer stability during uncertain periods. Given the risk of financial instability and market disruptions, diversifying across high-quality fixed income securities would help mitigate potential losses while benefiting from rising bond prices at the interest rate decline. These are some references I have used, and thank you for your time and attention.